Hello everyone! My name is Jin. I'm a full-time mom and a property investor in the UK. I specialize in family lets in the northeast of England. In this video, I want to share with you how to be tax efficient in property investing while being in the UK. As property investors, we want to be serious about three types of tax: income tax, capital gains tax, and inheritance tax. Before we crack on with any of those, there are two important rules to be tax efficient in property investing, so please write them down. Number one, never sell your investment properties. And number two, as the property value goes up, increase the debt against it. Now, these two rules come about because of how taxes work in the UK, so you need to understand all three taxes to be tax efficient. I'll be explaining these in three separate videos, so make sure that you stay tuned to this three-part mini-series. Now, if you feel nervous about the rule to increase debt as the property value goes up, please watch my other video on bad debt and good debt to understand why it is something you don't need to be worried about. Right, so let's look at income tax. Imagine we have two identical persons, Sam and Kim. They're identical in every way. Same job, same income for the next 15 years, same age, and they buy identical houses right next to each other. They both have a house that's worth £90,000 and they pay a deposit of 25%, and the remainder of the mortgage loan is therefore £67,500. The mortgage is interest only at 4.75%, and the house gives them a monthly rental income of £650. That's the gross income. Then there are expenses like the mortgage, which is £253, the maintenance, that's £80, insurance, that's £20, and letting agents fee of £78. So this gives them a net income of £219 a month. In really simple terms, if you are a 40% taxpayer, you would pay 40% on that amount. And if you are a 20% taxpayer, then you would pay 20% on that amount. If you're not a taxpayer, then you don't pay any taxes on that. It isn't exactly like that at the moment, especially with the Rule 24, but for simplicity and to check this principle, let's look at it this way. Let's assume that Sam hasn't looked at my video about good debt and bad debt, and he has a saver's mentality. He thinks that all debt is bad, and he plans to pay off his mortgage in the next 15 years. Kim, on the other hand, has watched my video and he understands the difference between bad debt and good debt. This one is a good debt, and she decides to keep her mortgage and not pay it down. So what's the reward for Sam in 15 years' time when he has paid off his mortgage? If we fast forward 15 years and he's already paid off the mortgage, that's another £253 that will go down to the bottom line as net income. The government will come along and say, hey, you two have the same job, you have the same property, and the same money coming in. But Sam, because you've paid off your mortgage, here's the reward. You have an extra £100 to pay in taxes. Congratulations. Everything is identical, but Sam has to pay £100 more in tax only because he paid off his mortgage. Would you ever pay your mortgage down if you had to pay more taxes? The first rule, therefore, is that we're not going to pay down the mortgage. We're only going to pay interest-only mortgage. If you have a repayment mortgage, then you're paying it down. By the way, while Sam was busy repaying his mortgage, Kim could have been partying with the £67,500, or if she's a bit more wiser, she would have invested in other properties and now would have 4 other properties going up in value instead of 1. Another reason why you should not pay down your mortgage. Let's talk about Kim now. She doesn't pay down her mortgage. She keeps the property with the same mortgage. Her rent is going up every year by about 3 to 5%, from £650 to £670 to £693, and then £710 a month. The problem is that this will put an extra £60 per month on the bottom line as net income. She will then have to pay more taxes. Now, over the next 3 years, some of the bills would have also gone up, let's say with inflation. So, for example, the maintenance fees would now be £90 a month. The other thing that would have gone up with inflation is the value of the house. Now, Kim can go back to the bank and say, "Hey bank, the house has now gone up in value. Can I re-borrow 75% based on the new value?" The bank will say, "Of course you can. You just have to pay a bit more mortgage." But that's fine because the increased rent will pay for it. So let's look again at the numbers. Let's assume that the mortgage now goes up to £303 a month. Remember, Kim now has £60 extra of rental coming in each month at £710. But she also has about £50 to £60 of additional expenses. So her net income remains the same, and therefore her tax remains the same. So if you follow the second principle of increasing your debt against it when your property value goes up, you stay income tax efficient. Now this is a principle. It's a bit more complicated than that, but the principle still holds true even with Rule 24. It works, and this is how you do it. I hope you enjoyed this video and learned something new. Remember, I am not a tax advisor or an accountant, and you should always get professional advice before making a decision. Nonetheless, in the next video, I will be covering the capital gains tax. Please like this video if you haven't and subscribe to my channel. If you're looking to start your property investment journey, or if you have some money but no time and no experience, please feel free to reach out to me and I'll be happy to help. I'll see you in my next video. Bye!